Hey everyone, happy Thursday, February 27th. It's about 10:45 in the morning on the West Coast, and it's time for another market update. It was a busy week, lots of housing data. We got all the housing reports we want to see, got appreciation data, and then mortgage rates actually had a really good week. So we'll get into that and find out why. But starting off first, like I said, we got every home sales report we look at in the industry. We got existing home sales, new home sales, and pending home sales for the month of January. So taking a closer look at those ones, go back here. Existing home sales was down about 5% month over month at negative 4.9%, still up 2% year over year. Month over month was slightly lower than expectations, and then year over year increased for the fourth straight month. Median home prices dropped slightly, about down to 396, still up almost 5% year over year. This is an important part of this because you see it a lot in the news about inventory spiking. And yes, it was up 3.5% month over month and up almost 17% year over year. But here's the important part, it's still 17% below what it was in January 2020, which was right before the pandemic, what we would consider normal times, a normal market. So we're still 17% below that. So definitely inventory is going up, but it's still below what a normal time. Uh, so as I said, normal market's about 4.6 months supply. We're at 3.5 months supply, so still a little bit of a seller's market. But we do see days on market trending up across the country. So it was 36% now, or I'm sorry, 36 days now up to 41 days. So that was existing home sales. New home sales. This is new construction. Signed contracts on new construction down quite a bit, down a negative 10.5% month over month. They did make a positive revision in December, which made this number bigger. So if you just went off the original number, it was still a 7% drop, down about negative 1.1% year over year. Median home price jumped almost 8%. That tends to be they're building more expensive homes. And then for sale inventory. Right now, there's about 495,000 new homes for sale across the country. But only 115,000 are completed homes. 106,000 are just dirt; they haven't been started yet. 274,000 are have been started under construction. So a lot of people want to see the finished product before they buy. So with the actual month supply, completed homes is really only 2.1 month supply if you just wanted to go out and make an offer right now on a completed house. So again, down, but again, January is a cold month. It was I think the coldest winter in 25 years, or coldest January in 25 years in certain parts of the country. So that could definitely have an effect on things. And then today we got pending home sales. So these are not homes that close in the month of January, but have gone pending. They're under contract now in the month of January. And that dropped negative 4.6% to 70 point, and their little index NAR does is at 70.6. That's actually the lowest, I believe, since they started tracking this in 2001. The drop was led by the South, down negative 9.2%. The Northeast was, up actually a little bit, which is interesting considering that's where a lot of the cold was. So that didn't seem to stop the Northeast. And then the West, where we all are, was down about negative 1.2%. So not good to see numbers dropping across the board in all these reports, but also tends to be kind of standard this time of year with the cold weather and whatnot, kids in school and holidays just going on and everything. Next thing we got December home appreciation. Remember, home appreciation kind of lags. We're into February. We're just getting December's numbers, and home prices continue to go up. So remember, we get two of these. The gold standard one is the Case Shiller. That went from 3.7% to 3.9% year over year. Seasonally adjusted up a 0.5% month over month. Non-seasonally adjusted down just a little bit. But again, this time of year, they tend to seasonally adjust things with the weather and everything. FHFA, which is similar to Case Shiller, but does not include cash deals, people paying cash for a home, and does not include jumbo loans, which are bigger loans. That went up 4.5% to 4.7% year over year, seasonally adjusted up 0.4% month over month. So again, great for homeowners, current homeowners. Your homes are appreciating, prices continue to go up. That's great for those folks. People on the sidelines, renters thinking, I'm going to wait, to buy. That's, where it's not necessarily good to see home prices continue to rise. Initial jobless claim. So this is important. We know the Fed's paying attention to inflation and jobs. This has been low pretty much. The estimate was 222,000. It jumped to 242,000. So maybe this is the where we see these numbers start to climb. Anecdotally, we know that Doge, Elon, and everybody is eliminating a lot of government jobs. Government jobs prop up a lot of these job reports quite a bit. So with all these people being laid off from these government jobs, maybe we start to see the labor market weaken. Which again, don't want to see people lose their jobs, but that's one of those one of the factors that the Fed's looking at. So if we see more labor weakness and inflation come down, that's when we can expect rates to come down. So want rates to come down, don't want people to lose their jobs. Miscellaneous stuff. So today we got the fourth quarter of 2024, the second estimate. They do it three times. GDP estimate. So it was expected to be 2.3. It was 2.3 last time, and it was 2.3 again. That was mainly, propped up by consumer spending, some government spending, like we were talking about. So it'll be interesting to see, what 2025 first quarter looks like once we get those numbers. But overall, still growth, but slowing down. And again, the hotter the economy looks, the less likely we are to get a rate cut. So anything that kind of makes the economy look like it's slowing down, people are getting laid off, inflation's coming down. That's what we want to see mortgage rates come down. Next thing, so the average 30-year conventional, according to lender survey for top end borrowers, we dropped from last week at 6.96 to 6.79. And again, there's not a very clear reason why. A lot of it just had to do with market sentiment. A lot of investor sentiment right now is the economy is slowing down. So economy slowing down, like I said, that tends to be good for mortgage rates. Sometimes there's a flight to safety to mortgage bonds where people have money in stocks, people have money in crypto, and those have been going down over the last week. So maybe some of that money got switched over to mortgage bonds, which is helpful for our rates. But either way, we had mortgage rates come down quite a bit, which was nice to see, and it'll be nice to see if that continues. And one of the things that could make that continue is tomorrow's inflation report. We're getting the PCE inflation. This is Fed's favorite form of inflation to look at. Right now, the expectations are pretty positive report, but again, you never know with how these are going to come out. But if we see a good number here, that could probably continue this rally. If we see inflation creep higher than expected, maybe we give back some of these gains we had over the last week. And then coming up, then we'll have some jobs reports in between here. And then on March 19th, the Fed meets once again. Right now, they have it at about a 2.5% chance they'll cut rates, 97.5% chance they stay where they're at. So right now, it doesn't look like we're getting a rate cut. It would take some pretty crazy stuff happen over the next couple of weeks for that to happen, but maybe it will. You never know. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week, and I'll talk to you guys soon. Thanks a lot.